Last week, one Bloomberg report wiped out billions of dollars in market value in a matter of hours. Meta announced it's building something called Meta Compute, a cloud business to sell its excess AI computing power to outside customers. And the market reaction was instant and brutal. Meta stock jumped almost 10%, its biggest single-day gain in over 5 months. But on the other side of the trade, CoreWeave dropped 30% and Nebius fell over 20%. The same counts for the other Neocloud stocks like IREN and APLD. These Neocloud stocks have been some of the hottest names in the entire market this year. Nebius was up almost 150% year to date before this news hit. So will this be the end of the Neocloud boom? Or is this actually one of the best buying opportunities we've seen all year? What's important to understand is that Meta is a customer of the Neoclouds, not a competitor, at least not yet. In April, Meta expanded its cloud computing deal with CoreWeave to $21 billion, and it signed contracts with Nebius worth up to $27 billion over 5 years. That's roughly $48 billion that Meta committed to renting other companies' GPUs. Why? Because Meta's own data center build-out couldn't keep pace with its AI ambitions, so it paid the Neoclouds to fill the gap. Now flip that around. What did Meta just announce? That it's building tens of gigawatts of its own AI capacity, and it wants to start selling computing power instead of just buying it. One analyst at D.A. Davidson summed up the fear perfectly. His point was basically this: the damage from Meta entering this market will hit the Neoclouds, because companies like CoreWeave and Nebius depend on Meta for their growth, and Meta might simply not need them anymore. Read that again. Their biggest customer might become their biggest competitor. And for Nebius specifically, there's an extra layer of risk here: customer concentration. When a huge chunk of your future revenue is tied to one single company, that $27 billion Meta deal, that's amazing when the relationship is growing, but the moment that customer starts building its own capacity, that strength becomes a weakness overnight. That's why the sell-off was so violent. The market wasn't just repricing one bad headline, it was repricing the entire relationship between Meta and the Neocloud sector. But hold on, before you panic sell, let's look at the other side, because there are some very strong arguments that this sell-off was a massive overreaction. The 4 strong arguments for an overreaction are fixed contracts, world demand versus supply, Wall Street price targets, and no confirmation on extra compute. According to analyst research, Meta does not have the right to resell the capacity it leases from CoreWeave, and that restriction runs through 2032. So Meta can't just take the GPUs it's renting and flip them to customers. Whatever they sell, they'll have to build themselves. And building data centers takes years, so this secures revenues for stocks like Nebius and CoreWeave for at least the coming 5 years. But what happens after that? A possible collapse for their revenue growth rates? Meta's total AI compute capacity for the coming 3 to 5 years will increase rapidly, as you can see over here, going from 4.5 gigawatt to 14 gigawatt AI compute by the end of 2028. That's an impressive ramp up, knowing how big 1 gigawatt site is in reality and how long it takes to build them. But this is still nothing compared to the world demand, because when we take a look at the worldwide demand for AI compute data centers and the supply of them for the coming 5 years, you will see that the supply won't catch up to the demand anytime soon. The main reason for this is not the lack of capital and investments, but power availability. But for the foreseeable future, the demand for what these Neocloud stocks can provide won't go anywhere. This is also the reason why a ton of players are starting to join this market. SpaceX is renting out compute, now it's Meta turn, and literally one day after the Meta news, SoftBank announced it's entering the Neocloud market too, with a new company called SB Neo. They are targeting 10 gigawatts of data center capacity by 2030. So now we know that Meta won't be a threat to these Neocloud stocks. But which out of all these data center stocks are the best to buy right now? For that, I made a data center stocks section in my Mr. Invest sheet, where you can see all of them with their potential upside and risk attached. If you have never heard about some of these stocks, I would really recommend you to join the Discord, where you will find the link to my Mr. Invest sheet. It's completely free. I also sorted all these stocks based on the secured power pipeline, and it's showing us that HUD, Oracle, and IREN are the top 3 data center stocks with the most power pipeline, but that doesn't mean operational data centers. That's for most of these stocks still a fraction of their total pipeline. Now, knowing that building out these data centers will require a lot of capital, I made sure I looked at the stocks, their cash pile, and how much they will likely have to dilute shareholders in the future to fund the build out. I did this because dilution will hurt the stock's EPS, and that's why it's very important to look at dilution adjusted EPS numbers. Now, if we head over to the upside potentials for all the data center stocks, you will be able to see that the popular names are not at the top of this list. Nebius is still forecasting a very decent 100% gain by the end of 2028, but at the same time you can see that names like IREN and CoreWeave are now a better deal while having a similar risk profile. I got every stock above IREN, with IREN included. But what's so great about my Mr. Invest sheet is that I can make calculated decisions to get out of these names at the right time. In my Discord, you are able to see exactly when I buy and sell stocks. I now connected my Trading 212 account, so it automatically registers every minute I buy or sell something and how much. Now I I've already covered 2 stocks out of this list in my latest video. Those were GPUS and Soluna Holdings. I definitely recommend you watching that after this, but now I want to go over the stocks HIVE, VIVO and Gorilla Technologies because they've got some exciting news that I need to share. The first data center stock on the list I want you to start your own research on is VivoPower. Make sure to take action as soon as possible because time is running out for this one. VivoPower is a tiny company sitting on one of the most valuable things in the world right now. Cheap, green electricity already hooked up to a working data center. Exactly what AI companies are desperate for. VivoPower develops, owns and leases powered land and data center infrastructure for AI compute. Their pitch is sovereign AI. They are helping countries build and control their own domestic AI infrastructure instead of depending on foreign tech giants. The perfect example of that is now Meta. In April 2026, VivoPower bought a 41.5 megawatt fully operational data center in northern Norway for $41 million, roughly 4 times its yearly profit, so basically for a PE ratio of 4, which is dirt cheap. The power costs below 3.5 cents per kilowatt hour and 100% renewable. That's among the cheapest electricity in the world. On top of that, this site is sitting in the Arctic. That means free natural cooling, which is one of the biggest costs for AI data centers. On June 29th, 2026, VivoPower announced it selected a preferred long-term AI tenant for the Norway site, described as a global AI industry leader, chosen from a competitive bidding process. The company expects to reveal the tenant's identity and the lease terms in the near term. And what's even better, the talks have expanded beyond Norway. The 2 sites are already negotiating deals across VivoPower's wider pipeline in multiple countries. If the tenant turns out to be a big recognizable name, that changes everything for a company this small. The second must-have data center stock out of the 3 is called HIVE Digital. HIVE is a former Bitcoin miner, which is now building data centers powered by green energy in Canada, Sweden, Paraguay, and Bermuda. Revenue is exploding, big contracts are landing, and analysts see 100% plus upside. Revenue for fiscal year 2026 came in at $297.8 million, up 158% from the year before. They signed a 3-year GPU cloud contract worth around $220 million. HIVE is planning a 320 megawatt AI gigafactory near Toronto that could host over 100,000 GPUs, positioning it as a major Canadian AI data center player. Analysts are calling the stock undervalued compared to other AI data center companies, trading only at a price to sales ratio of 3, while their peers got much higher premiums. Earnings estimates have been revised higher over the past month. Expectations are rising alongside the business. The company has low debt and some breathing room on the balance sheet, but is clearly in build mode. And this is just the early innings. Now this third data center stock is experiencing explosive demand and signed recently new deals. And it's called Gorilla Technologies. Gorilla Technologies is a small London-based tech company that's transforming from a security camera software business into a full-blown AI infrastructure player. And the numbers are starting to prove it. They are a $500 million company sitting on billions in contracted and pipeline revenue, riding one of the strongest trends of the decade. AI infrastructure in emerging markets like India and Southeast Asia. In 2025, revenue was about $101 million, up roughly 36% from $75 million the year before. With positive operating cash flow and a strong cash position, just days ago the company raised its Q2 2026 revenue outlook to at least $44 million, driven by contract wins and accelerating AI infrastructure demand. Full year 2026 guidance was raised to $160 to $200 million, and that would mean roughly doubling revenue in a single year. Gorilla recently signed 5 massive contracts. Now to fund these projects, they will need a lot of capital. So Gorilla just completed the acquisition of Shackleton Finance and launched Gorilla Tech Capital, a new regulated capital platform to mobilize institutional capital for AI infrastructure, data centers, and GPU as a service projects. So instead of diluting shareholders every time they need money for a project, they can bring in big institutional investors to fund the builds. And Wall Street is waking up. According to 3 analysts, the average rating is strong buy with a 12-month price target of $36.67. Do I think Meta just crushed the Neocloud stocks? No. The panic was about a Bloomberg report on plans that are still in development. Meta hasn't even confirmed the details. And the hard reality is that Meta has no spare capacity today and can't legally resell what it rents from CoreWeave. And this is important. The market just learned something it can't unlearn. The Neocloud's biggest customers can become competitors at any moment. That risk deserves a permanent discount on these stocks. After all, the AI compute demand story is alive and well, but the Neocloud trade just got a lot more complicated. And picking the winners now requires looking at contracts, customer concentration, and balance sheets, not just riding the hype. If you found this breakdown useful, smash that like button. It genuinely helps the channel. And let me me know in the comments if you are buying this Neocloud dip or staying away. After that, I suggest watching this video, where I covered one of my favorite data center stocks.